This is the Real Estate Power Play Podcast, getting you the information that you need to be a successful real estate investor. Hosted by Mark Monroe, Ronald Walker, Gabe Rodarte, and me, Marty Grizzanti. Combined, we've done thousands of real estate transactions. So get ready for real stories and true case studies on finding deals, growing portfolios, and making money. Welcome to the show.
What's going on, everybody? Welcome to Real Estate Power Play. Today, we got a real treat for you boys, as Brad Lee likes to say. We're going into the world of hard money, right? The world of hard money. How do we finance these deals? What does the details look like? And we want to really go through a number of things for you guys. We got Mark, we got Marty. We're going to go through understanding what hard money is, the pros and cons of using hard money, how to talk to lenders, and all of the little details to get your you get your deals financed, closed, and that you can make a profit. So, guys, thanks for joining me today. Mark, how you doing, man?
I'm doing great. Can't complain. I was back home. I was in Nashville at the seller financing note conference, and that was amazing. So, that's another great strategy of being able to purchase properties through seller financing. But it was wonderful. How about you, Marty? How you doing up there?
I'm doing fantastic. I mean, other than the Canadian wildfires and all the smog that's coming into Rochester, I can hardly breathe. But, could be worse. Could actually be in the fire. No, so far so good. But I'll tell you what is on fire is this episode and what we're about to talk about, and real estate in general. So I'm looking forward to talking about hard money because this is how we build our empire. It's how we build our business.
Dude, that's right. We can't purchase any properties unless we have the capital to do it. And you can either use your own capital, which most of us don't have when we start off, especially. Two, we can connect with a private lender or a family member that we know. But if they're not 100% down, or maybe your family doesn't have money, there is some other options out there, right, that are specifically geared towards us as investors and investor type loans. And so I don't know if we've actually talked about this, guys. I don't know if we've had an episode on financing and working with hard money lenders or anything like that. So guys, this is going to be really awesome. And so I guess to kick us off, just from the very top level, Mark, I'll start with you. Like, what is hard money? And how is it different than going to Wells Fargo or Chase to get a loan, right? Because most of the time people get into real estate and they're like, oh, I can't buy an investment property because I need 20% down. Well, I can tell you I don't put 20% down when I buy my deals. So what is the fundamental difference between hard money and traditional financing to kind of bring people into the world?
Sure. So traditional financing is when you go through a lending institution like, say, Bank of America, or Chase, or Countrywide, or Quicken Loans, where you actually have to go through the process and qualify for a loan. They want to make sure you can afford it. They run the DTI income. They want to do inspection. They want to do the appraisals. So it's a whole formula that they tend to follow to make sure that the asset, the money that they're lending to you, that they're going to get their capital back. So that's traditional way. And then hard money is mainly guys that will go ahead and lend based off of what the property's worth and give you some the financing as well to fix it up. And it's really popular for fix and flips, where they don't care about you as much. Yes, they want to look and make sure you know what you're doing, but they overall look at the project versus looking more in detail at you. That's kind of in a nutshell the difference between institutional and hard money. If anybody wants to piggyback off of that, go right ahead.
Yeah, Marty, maybe to kind of take that one step deeper, Mark, I think that is fantastic. The differences is really in the world, right, of financing, of lending. It's almost like a different language. Marty, what would you say the difference in terms are between going to a normal bank and getting the hard money? What can people kind of expect when it comes to actually borrowing? What do those terms look like?
Yeah, so traditionally hard money is for a short period of time, right? This is kind of like a gap funding, or it's a bridge loan, so to speak, in order to either get the property fixed and then flipped and sold, or fixed up, the value was added and then refinance and then bringing in an institution. So because it's only needed for such a short period of time, and because normally the properties are not at their max optimization, right? The value hasn't been brought there all the way. You're looking at a higher interest rate. But again, it's a shorter period of time. You're not doing this for 30 years. You're not doing it for 10 years. You really just, normally a lot of times what you see is about a 1 to maybe 2 years at the most of a hold period of keeping that hard money. So, here in Rochester, you see a lot of 12 and 2. It's now 14 in 2. And when I'm saying those numbers, 12% is typically what a hard money lender is going to want, right? And that sounds like, holy crap, 12%. Especially 3, 4, 5 years ago when you were getting interest rates from the bank at 2, 2.5, 3, 3.5, right? So, but now it's not that crazy of a difference, because now you're getting an interest rate for a house at about 7% or 8% if it's commercial. So now it's not that much crazier. But yeah, just to answer your question, it's really the interest rate's going to be a little higher, or in some cases much higher. But depending on how you underwrite, it should make sense. And at the same time, it's a shorter period of time than a bank loan.
Dude, that's amazing. One of the reasons why so for a long time, I actually didn't use hard money. I hated going to hard money. I thought it was way too expensive, and actually it deferred me from going after flips for a long time. But one of the things, guys, when you think about what hard money is it's a investor. It's another investor who created a hard money company, or it might be, a company that's really servicing investors to buy discounted properties. And just like Mark said earlier, they're not actually looking at you. They're looking at the asset, right? They're saying, okay, does this asset have value that can be added? And how much value does this asset have? And they're going to lend to you based on that asset value. Now, the second question they're going to ask is not what's your credit worthiness, what do you have here? What they're going to ask is this person I'm lending to credible, and will they be able to complete this project, right? That's what they want. Because if things go sideways, the hard money lender steps in, takes over the project at whatever their lending basis is, and that they will finish out the project with some equity. They don't want to do that. They just want to lend their money, make their 12% and their points up front, which is just a percentage of the lend amount, and make it. But for us, it gives us the ability to close in literally 7 to 10 days, right? They can underwrite the property very quickly, and they will have the money wired to your account 7 to 10 days. Some of my lenders will do 3 days because of relationships that we've built. And so it allows for a very, very quick close on a good deal, so you can pull the trigger. And then they provide flexibility so you don't have to bring all your cash to the table. So you can have 1 or 2 projects going on, and you've had essentially, $300,000 in cash to be able to buy the property given to you for this short period of time. But yeah, the interest rate is a lot higher. So, Mark, I guess maybe going into a scenario in which you've used hard money lately. What is an example of a deal that you used hard money on, and kind of what were the numbers looking like? What were the estimated amount that you paid for it? What were some of the details?
I've not used hard money in several years. I tend to use more private money. For me, the private money actually becomes, I guess you want to say, my hard money. But I don't get beat over the head because I know these people. Versus if you don't know these people, they're going to end up pretty much really beating you over the head, like what Marty was saying. Typically, what you're going to pay upfront fees, and then you're going to pay back fees. But the typical, what you want to do is, just when you're looking at a deal and you're underwriting a deal, just add that cost into your deal analysis and kind of make sure that you have enough spread in there to be able to cover that. I would say the last one I did that was private money / hard money was a fix. It was a rehab. I purchased it subject to. and I did a hard money just for the rehab cost, and it was $50,000 for the rehab. And when it's all said and done, that private money slash um, hard money, he ended up getting an extra $10,000 back, so he got 60,000. So it was probably out there for about, say, 2 months. It was about 50 days, but we'll say 2 months, and that's the type of return that that particular person got back on my last one. That's kind of usually what I tend to do. Or for me, I'm a little bit more creative when I'm structuring my deals. I kind of do different things, so I don't have to use the hard money. But anyways, that's kind of probably the closest thing that I've used last in the hard money. Trying to remember, somebody was doing a hard money. Oh, I know what it was. I just helped somebody structure a hard money loan by a mobile home park, and the rate on that is at 14% on a 2-year balloon. But the numbers made sense on that particular mobile home park. So, and it worked out really well. So and they actually ended up getting some cash back at closing on that particular one. And they had the seller stay into the deal as well on that one. So the seller held a second in the hard money. And that's the beauty of hard money. They'll allow you to have a seller put a second on there versus if you go traditional, they won't allow it. They have what's called CLTV, combined loan to value, and they want to make sure that there's enough equity in there, so there's risk on that. So, but if you use hard money, a lot of times you can have a seller carry a second, and the hard money lender is just going to worry about the first position of what their exposure is. They want to make sure if something happens, you don't perform, they take that property back, they can turn around and resell it.
That's strong. Marty, do you have an example of a deal you bought with hard money recently?
Yeah, so we're fundamental, just kind of right to the, hey, this is what it is. It's a fix and flip. Mark's very creative. He's been in the business a long time. He's got that background. But for, meatheads like Matt and I, we're just looking at, all right, hey, what does it make sense if we come to this hard money lender with, if we bring him a deal, is he going to lend to us? So, for instance, we bought a couple rentals at $200,000 is what we borrowed at 12% and 2 points. So what does that look like? Well, if we borrowed it for the entire year, the $200,000 would be $24,000 worth of interest, right? And then plus the 2 points, that would be $4,000 in points, right? So at closing, you're going to pay the $4,000. So let's just start from the beginning. We have the properties, $200,000 we're buying them for. They're worth $400,000, right? So we're making sure when we're going to these people that it makes super sense for us, and it does. All right, cool. So we're borrowing the $200,000. We have the money with credit cards that we're going to use to do the rehab. It's nothing crazy. So we're not going to borrow any money, but in some cases, depending on who you borrow from, you could just tack that on to the loan, and they might give it to you in draws depending on when you need it, or they just give you the whole kit and caboodle at closing. So let's say you're borrowing the $200,000. I'm bringing $4,000 to the table, not $200,000, $4,000, because it's a cash deal. Remember, you're not going to be able to get a loan on these properties. So even if I wanted to go to the bank's still not going to give it to me, right? So there's a lot of cases, especially when you're selling to that seller. Hey, Mr. Seller, work with me. I'm not going to go get a bank loan. Oh, by the way, if I wanted to get a bank loan, it would be 20% of $200,000, right? Because this would be a commercial loan. So I'm buying an LLC. So you got to keep that in the back of your head. And oh, by the way, they want to move fast. The bank's going to take a long time. They're going to underwrite you. They're going to be asking you all these questions about why you're doing what and why and where and who and how. So that gets rid of all that. And then back to the question of, what did it look like? Again, it was a $200,000 deal. It was $4,000 at closing, right? Plus closing costs. So you're looking at around like $6,000 now. And now we're into these two properties for $200,000 that are worth $400,000. And boom, we got a lot of value created because of that relationship. So that person was able to really get us a $400,000 deal, right, for $4,000. Now, yeah, there's going to be the interest, which is going to be broken up into monthly payments of $2,000, right? But I only need it for 4 months. I'm going to go in and out, boom, and refinance this thing. So really, does it cost me $24,000? No, it really just, it cost me, I got to do the math because I'm a ding dong, divided by 12 times 4. It's only $8,000. So now I'm really into it with the rehab being 10, the 8,000 in interest, and then the 6,000 for the points and the interest, right? Or in the closing. So all that value is created because somebody's got money and they're looking to lend it, right? So, a lot of people, when they first start out, they're trying to do it all by themselves. Listen, you don't get any credit from me or anybody because you're using your own money. Okay. Mm-hmm. If anything, you're not doing it right. You're not thinking, first of all, you're not using people who want to work with you and developing relationships. Like Ronnie, I'm sure he's banging himself over the head. He's like, damn, if I would have started doing this years ago, my rates would have been way lower. I would have way better relationships. I would learn more about the business than I would have done if I tried to use my own money or not do it at all, right? And so just wholesaling it out and not making any of the money from the burr or from the flip, right? So anyway, that's a little bit on the math and how we did it and how we're doing it. And it's really important, guys. This is a really good topic.
Marty, I really like what you said, because that was a big problem of mine. Is I hadn't, you can buy deals, especially if you have your own cash or you're wholesaling, and, let's say you wholesaled 15 properties and now you have cash to be able to buy one and then sell it. That was what I did. I didn't want to get a loan on anything. I was so nervous of going through that process. Well, what it did was I created experience through wholesaling, but I didn't create third-party credibility, right? And that credibility, that reputation with people in your marketplace is so powerful. I'll give you an example. I just closed yesterday. I closed on my Grand Rapids or my Grand Haven flip. And I used a new lender that I've actually had a relationship with the guy since 2018. And he's hard money / private money. And, we were texting and WhatsApp, and he sent me a voice message. He's like, I appreciate you doing what you say you're going to do. We've been friends for a long time. And I took a risk on you, and I'm glad I did. You did everything you said you were going to do. And we had some hiccups. I had to fire my whole crew in the midst of it and then take it and plan. And I was totally upfront with him the whole time on what was happening. And he was like, dude, you did this and you sold it. I sold the deal 30,000. We had an estimated 294 resell. I told him it would sell for 315 or higher. He had 294 and we sold it for 328. And so even that, he's like, dude, you were on the money. All of that to say, what happened as a result of that, guys, is we're talking about hard money, is it created a person who's lent me money, who's had a successful experience, that not only will lend me money again because I did what I said I was going to do and I had accurate assumptions, but two, his network now, he's willing to endorse what I've done. Oh yeah, Ronnie did what he said he was going to do. And that's what's really cool when you start borrowing money from either hard or private, is you have individuals that are like, hey, he did what he said he was going to do. He paid me back. Right? He got the money back. And that's when the floodgates actually open up. They might test money with you initially, but then they're like, all right, you're actually doing something. Let's go. That's really powerful, Marty. I'm so glad you touched on that. Guys,
look, Ronnie,
go ahead.
The deal is there's a lot of money out there, but there's not a lot of operators, right?
Yes.
There's not a lot of people that are willing to go through the pain and the strife of the buy and the analytics and the due diligence. And, oh, by the way, you might have to fire your crew, right? A lot of people can't stomach that, right? And that's not for everybody. And there's nothing wrong with that. But there's a ton of money out there that is looking for operators. So if you are a good operator, you might as well go and look and get OPM, right? Other people's money, so that you can start building that, not just the credibility, but credibility with yourself. I'm a capital returner. Marty Grizzanti returns capital. I am a capital returner. I'm the best, right? So investors love investing with me, because what does that do? It builds up my confidence for the next deal and the next deal, and where I'm now looking at larger deals because I've already done this. This is what I do. I return capital, right? I do it effectively, and I do it, I do it smart, and I make sure I do, that we're not being, we're not being wild, but we're doing it in a way that hey, this works and here's why, and I got the evidence to prove it, right? So you should do it, especially if you can.
Mark,
I just want to piggyback off of that. So the way I look at it is, and Marty, your example, like it cost you $8,000 for that deal, right? For the interest. The way I look at that, I go to my friends. I'm like, hey, you know what? I'd rather have you make this money than some Joe Schmo down the street that's going to lend me the money and then that's going to charge you. Here, why don't you make this $8,000? That's my approach, and that's how I go about it because I know what they're going to charge me, and I have friends, and they all have money. They have IRAs, they have 401ks, and I'd say, hey, I would rather you make this money and partner into the deal, or you be my lender on it, than going down to somebody else. So that's kind of how I go about it, and that's how I look at it because I want my friends to also people that work with me to make sure they're getting a good return. Hey, because they're going to get more better returns than they're going to put in the bank or even the stock market right now, in a short time period. So that's kind of how I look at it.
Mark, I think that's super, super strong. And guys, you can see how by opening up this window and kind of jumping into this world of borrowing money, right? Of using opium, as Marty said, when we open up this world, all of a sudden it provides these options where you can go and maybe get a cheaper rate from a friend, or, maybe you're borrowing from two and you have another one, and that lender, is connected in the commercial realm. So you're like, what, I'll pay those higher fees to create this relationship. Because once you borrow money from them, all of a sudden a two-way conversation opens up, right? I borrowed money from a guy and I told him with my construction process, is like, yo, I need help. Like, you sold a construction company. I know this is how you did it. Like, what was your process? He sat with me for an hour and a half on a Zoom call while I took 2 pages of notes, walking through the entire process he used to sell his company. Why? Because I borrowed money from him. That's so powerful. And Mark, I want to go back to something you said earlier. You said you borrow from private people or you do creative financing because you're not beaten on the head. And guys, as we're talking about hard money, I really want to dive into the benefits, but also some of the drawbacks to hard money. What do you mean by beating over the head, or what are some of the drawbacks? Why would someone be scared or nervous of going into hard money? What are some of those things they should look out for, or they should be aware of, or they should try to maybe negotiate terms, or just know, what, this is going to be a pill that you have to swallow when you start going in and borrowing money?
Yeah, I mean, one of the biggest things, especially in the market that we're in right now, when a market is hot, it's a totally different. But if you're in a market and the market is starting to pull back and you go into it and you're analyzing your deal and you're looking, this is what my profit is, but the market is pulling back and you're not going to be able to sell it for what you thought, and you're going to have to take a 10, 15% discount. If you're using people like hard money guys, you have a balloon coming up and they want their money back in a year. So some cases where if you're using somebody that you have a relationship with, you can say, hey, you know what, this is kind of what we're running into. We may end up holding it, but because of this, you're going to end up making more money in the long run. So I'd say that's probably one of the biggest drawbacks. And then also, the cost. I don't mind paying as long as my numbers work. But I want to pay somebody that I want them to make money. I don't want it to give to somebody that I don't know, if that makes sense. That's kind of how I go about it. But I'd say that's probably one of the biggest drawbacks is like, making sure that, you have, if contingency, if something happens, do you have a backup plan? And that, during the last crash in 2008, a lot of the fix and flip guys, I would say probably 95% of them had to file bankruptcy because of the market pullback and they couldn't pay their private money people or the hard money guys back. So that's probably what I would recommend. Marty, what are your thoughts on that? What do you think one of the drawbacks are on that?
I think the drawback is this: there's no regulation. Not that there should or shouldn't be. I'm not saying that. I'm just saying there's so many fly-by-night lenders out there, and so many people in these Facebook groups, week after week or month after month, are getting scammed by these people to do an application or whatever it might be, where that's where they get their money, or I don't know how it works. But do your research. Really, there's hard money. The best hard money that I know are typically just older landlords who've been there right? And now they're just wanting their money to work for them, and they're willing to give people a shot, especially in areas and properties that they're familiar with, right? That's a really legit hard money. Some of the nationwide ones, I know that they're out there and they are good. I know that there's some out there. I would just recommend when you're first starting out, without having connections with, masterminds and all that, where you can kind of get people to vouch for certain things, is try to find that local hard money lender who you could even use as a mentor. I mean, that's one of the benefits from the hard money that we've gotten in the past is, now we have really good relationships with these folks. And, now it's turned into private, right? Like Ronnie was saying. So anyway, but to get to your point, I really don't really like how a lot of these fly-by-night companies are out there and they're taking advantage of people.
I want to piggyback off of that. And a lot of times they're not even fly-by-nights. They're just straight up scamming. So just if anybody's ever asking for upfront fees, that's a red flag. You really shouldn't be on social media looking for money. That's my personal opinion. If you don't have connections and you don't know people, you should be in your local community. Go to your local RIOs. Go to your your local chamber of commerce and look for people, business people. Touch base, but don't go out there, hey, and looking for private money on social media. 95% of them are not for real. So, be very, very cautious on that.
No doubt. I love that. As we're kind of diving into this world of private money, and guys, if you have comments or questions about money, the money process often causes people to have the biggest nervousness and cause people to draw back and not take action because they're scared of it. And there's sometimes a lot of unknowns, whether it's the application process or asking for the money or whatever that looks like. Put your comments below. And if you guys are asking like other questions in the real estate process, we've got a ton of videos. If you go to just Apple or whatever, you can download the podcast and check it out, or go to our YouTube channel at Real Estate Power Play and check out the other stuff. But the really cool thing with hard money or private money is the speed of the transaction. And I really liked what you said, Marty, is that local guy often is very experienced. And so they know what to look for. And there's a guy here locally in Midland. His name's Logan. I was on his podcast, and he lends here in the Grand Rapids area and Michigan area locally. And one of the things that working with a guy like that is he doesn't want that loan to default. He wants that loan to go through. He wants to be able to have it paid back. He wants to be able to help the investor hit their financial goals. And so what he'll do is, as he's underwriting a loan, if the numbers look tight or if he sees like a discrepancy, rather than, this guy being on the hook for so much money, he'll actually sit down and be like, hey, let's unpack this together. And like Marty said earlier, dude, I love this idea of mentoring, but not necessarily paying for a coach to mentor you, but mentoring by literally being in the trenches with somebody who's gone before you and has an interest in what you're doing, right? And so when you get somebody to have an interest in you, whether you're JVing on a deal or whether you're borrowing money from them, it's such a good opportunity because they're choosing to believe in you. And this is one of the huge benefits of private money and hard money, in my opinion, is people now are beginning not only to believe in you, but then when you complete it, there is a true case study that you guys have worked together. And I think it's just massive. The negative side with the fees, what's interesting that I've found is fees are higher initially. Right? When you first start, when there's no credibility, it costs more. And so you gotta underwrite your properties accordingly. You gotta say, I'm expecting 3 months, but what if I hold it 7? Right? I'm expecting, a $20,000 rehab, but what if it's 40? And being willing to make sure your worst case scenario is, going to work for you. And so I think that's so key. But then those rates start coming down and start decreasing and decreasing. Marty, you've worked a lot with hard money and private money. What do you see that these people are really looking for when they're qualifying you? Like if you mentioned it before, I return people's capital, right? What is it that these guys, when you approach them and you're starting to ask for money, what are they going to look at you and say, I want to make sure Marty has what? What does that qualifying process look like?
Yeah, I think before we get there, we got a big question there. We'll get to that in a second.
Yeah.
Before you get there, I think it's really important to remember that we're the ones that have the prized possession. We have the deal, right? And a lot of times in the beginning, I think people get hung up on, oh, geez, how do I ask this person for money? And, oh, man, you're not doing them a favor, right? They're looking to deploy capital into something where they can see a return. Guys, at the end of the day, it's not the worst case scenario for a lot of these hard money lenders to take back that property. Okay. All right. Some of them see big money signs if you default. That's not the best way of doing it. That's not a good way. And I don't like that. But that is in the back of people's heads when they're lending on your asset, because it's hard money, not because it's hard to get. It's because they're lending on a hard asset, right? So they're not going to be ashamed to take that property. It's not going to go against probably what their business plan is, or probably just not what their business plan was. But again, it's not going to be a huge hang up. All right. But in regards to what I think they're looking for is they're looking for somebody who is going to get the job done no matter what, right? They're going to get it done. And how do you do that when you're first starting out? I think the deal's got to be really good. And when you're first starting out, truthfully, I think you got to have a background, and you can't be a bullshitter either. You can't be somebody when they're asking a question, you're just making stuff up. If you say, I don't know, that's okay. Right. Be like, it's everyone started, everyone became a beginner and had to look a little foolish in the beginning to become the expert. Right. But I just think a lot of times if you got a really good deal, and you should, if you're going to be borrowing people's money. Okay. And you better have a really good plan. If you don't have a good deal and a good plan, you probably shouldn't be borrowing anyone's money. And you should probably be going back to the drawing board and learning how to do this thing.
Can I piggyback on that? So I have this relationship with this one person. I'm not going to mention who they are. And I've never borrowed money from them. And I had a deal come up in Sand Lake that I'm actually using someone else. But I had a deal come up with Sand Lake, and they have mentioned to me multiple times, like, hey, I'll lend money to you. So I brought it up to them. I was like, hey, I got this deal, blah, blah. And I was talking. And I was just kind of throwing out not make-believe stuff, but I was just talking about it esoterically, right? Just from a theoretical standpoint, because me and this person never have really had this type of conversation before. And it was so interesting because, and this was a mistake that I made, was just because you're familiar with somebody, as soon as you start talking about money, to Marty's point, you got to know exactly what you're talking about. Because like I'm in the conversation like, hey, this is what it looks like. I've got this other property and this. And they're like, Ronnie, if I'm going to give you the money, tell me exactly the breakdown. I was like, hey, look, I don't actually have it right now. Let me call you back once I have all the details, because it just kind of came up in conversation, right? And sure enough, I came back, I brought it back up, but I wanted them to lend me a little bit more, and they were only comfortable with so much. But to Marty's point is, guys, it's about credibility. When you start talking about people's money, they want to know the details, and that you know the details, and you know how to take it from A to Z. All right, we've got a question here.
Let's dive in. Let's dive into this question as everybody can see it on the screen here. So it sounds like somebody that knows how to do some improvements. What I'd probably recommend, if this is your first time and you kind of sound like you're a little bit lost here, I would probably find somebody in your area, somebody that you can team up with on your first deal, if you're a little bit lost, to kind of walk you through it. Majority of us, when we first start out in real estate and we come across a deal like this, we're usually partnering up with somebody with experience. Yes, you're going to give up a little bit of money in the deal, but you're paying to be able to learn and get an education on it. That's what I'd first of all recommend on this particular one, especially if you know what you're doing. The last one you did, you use your own credit cards. and I kind of want to do that again.
Never want to
I
do
never
that
want
again.
to. I agree. You don't want to do that again. I highly recommend that, especially with the rates have jumped up a little bit. So I would first of all, it sounds like you know what you're doing because you've done one. Um, I would also recommend maybe trying to start finding people in your community, your local business owners, that you do business with, your dry cleaners, your restaurants you go to, start talking to them and have them get to know you. Your local closing agent and title companies, they can provide a list of cash people that did private money lending on that. So they could help you as well. And we all have access to certain online platforms where you can kind of pull lists too. That's what I'd recommend. Marty, how about you? Do you have any recommendations to this question?
Yeah, I would, like Mark said, find someone who's done it. I'm curious how you did. You didn't say if you did well or bad on the first one, right? But I'm assuming you never want to do it again. You probably didn't do too well. So I would definitely find somebody maybe that's got the money. And if you have the skill of doing the work, you can kind of combine those two, or someone who's got a track record and you want to just, hey, I'm going to come in as the GC contractor and maybe only you get, 10, 20% equity of the deal, or I don't know what it would look like depending on the situation. I would just try to find your yin to your yang and try to get it done.
Yeah, I really like that. I think that, great real estate investors, I came across this quote the other day, do not see themselves as risk takers. They see themselves as risk mitigators, that they are mitigating risk. And what JVing does is, yes, you're giving away a profit, but you're mitigating your potential loss, right? If you partner with somebody and they give you the money, you might be able to get it cheaper. You might have to pay a little bit more. I don't know the situation, but whoever you go to, if you do it that way, you're actually limiting your downside in case something goes wrong. Now, if you just want the money and you feel super confident, like you have a 5 unit, you're managing multi-single family, you can do the work, and you just want the money, my recommendation would be literally just go to the local RIAs, type into the association page or connections, or reach out directly. If you're in one of our markets, reach out and we can connect you with someone. And you just got to start having the conversation with the hard money guys. A lot of times we're just afraid to get uncomfortable and ask somebody and be like, yo, what would it look like if I borrowed money from you? Right. And we're just nervous about that conversation. So I got to go with these guys. Depending on where you're at in your journey, the answer is different all the way through. And money is different if you're looking at a $4 million commercial unit versus if you're looking at, a $75,000 war zone flip, in wherever. There's different mindsets to all of it. And so it narrows down to your specific situation and what you're trying to to jump in with. So
I have a question, or I have a statement. I believe this is the user. He says, I have a 5 unit. I manage 10 other single families. If this is the gentleman that's asking the question, whoever you're managing those properties for, partner up with one of those guys. Right there, that you kind of have it right in your network right there. If this is the same person, because we can't tell who the user is. And then they're saying another thing down here, I bought 40. So that looks like a nice deal if you use that in your credit card. So I mean, that worked out really well. If this is the same user that's asking this question,
It's a
about
local brother. That's
40 to
cool.
24.
Scottsville. Yeah, sweet. Yeah, send me any Scottsville deals. I love Scottsville. Uh, yeah, no, that sounds good. I don't know what to say other than that sounds good. But you don't want to do it again with your own money. That makes sense. Then go to a hard money lender. You proved your thesis. Your thesis has been proved. You did what you said you're going to do. You added the value. You got it worth to where it needs. To where it sounds like a really good deal. So anybody that's got any lending experience would love to work with you.
I think it's awesome. Great interaction, guys. I love the interaction. I think that's awesome. We actually got another question here. Let's dive into it. So I think this is somebody else. He says a property is ARV 90K, similar property sold for 135 in the area. less than 5K in renovations, which if it's less than 5K, that's like nothing. Just FYI, like that means it needs like nothing. 43 owed to the bank, mortgages non-assumable, 3.6% interest rate now. Would this be a good candidate for a hard money lender? One, it doesn't necessarily need to be assumable to do a subject to. So if the seller's willing to do a subject to, you could work it that way. And that's probably the direction Mark would be exploring initially. But Mark, you wanna break this down from a lending standpoint?
Yeah. So I put in the chat an amazing book there. Hopefully it all went through. It's called Matt is a really good guy. It's called Raising Private Capital Using Other People's Money. You can get it on Amazon. And it's Matt Fair. We've actually had him on before. He's a great guy. And his book is amazing, and he'll teach you a lot on how to just try to find capital locally in your community over there. All right, let me go back to this question here about assuming lesson. Yeah, I mean, 5,000 is just. I don't even think I would fix it up for $5,000. I'll just let it go as is. I wouldn't even put any money into it because, well, it depends on what you're trying to do. Your exit strategy. That's really what it comes down to. Like if you're going to just wrap it, or you're going to keep somebody in it, or if you're going to do a rental. Rental, you might have to put a little money, but normally what I like to do is I normally like to buy it in something like this scenario and then turn around and resell it through an exit strategy, a wrap, seller financing, or agreement for deed, or a lease option, depending on the state. And you don't assume the mortgage. And that's where a lot of people get confused on the subject twos. So you're buying it subject to the existing mortgage. So you're keeping the existing mortgage in place. If you're going to assume it, you got to qualify. It's just like going to your traditional bank. However, I do see a lot of sweet deals out there where you can assume a mortgage. I saw one where it's 2.75 unassumable, and it was a VA. If somebody can qualify that way and go down that path and get that loan for 2.75, do it all day long. But otherwise, you can purchase it subject to the existing mortgage and keeping the mortgage in place, and you transfer it over and you take possession of that property. Or you can also do what's called an agreement for deed, depending on what you're trying to do. Hopefully, that is not too confusing.
Yeah, and I think I'm actually going to share my screen. I want to show something. The way
so you users that are listening to us, Ronnie, try to be really clear because the podcast people won't be able to see. So just kind of explain to them a little bit.
So when you're doing a hard money loan, can you guys see my screen? So when you're doing a hard money loan,
just kind of explain it to the listeners.
Yeah. So you got to determine that sale price. So you said that sale price was 135. So we'll put in that here in the calculator, right? And his purchase price, when you're looking at it, you said the purchase price is. I showed my screen. What was the purchase price again? 90. What was the purchase price you said, Mark?
Hold on, I don't see it. Let me look for it here. 90,000.
So
with 5,000 in renovation.
Yeah.
They
so
owe 43.
Yeah, 90,000. So this is what it looks like. Okay, if you guys are taking a look at the calendar, if you do repair level, we're going to do 0. Just assuming you're not going to do any repairs at all. Okay. Now here's our hard money term. So we're going to say 12%, 2 points up front. You got to bring 10% down. And let's say your hold time is 4 months. Okay. On the deal. So in this case, you're going to have to bring $9,000 to the table. After everything's said and done, you've got a 135 resale, a 90,000 purchase price. If you have no money in rehab costs, after everything's said and done, you can look at the margin rate here once it's all done. Okay. And so what this allows you to do is plug in your costs. When you ask yourself, is it good for hard money? That's actually not the right question. The question is, can I make money on this deal? That's what you want to ask yourself is, can I make money on this deal? And would a hard money lender feel good about lending money here based on the numbers? Now, it doesn't actually look like my numbers are calculating correctly on this thing. It's showing up wrong. But that's what you want to do. You want to run the numbers with the interest and come up to figure out that hard money stuff. Guys, this has been like an amazingly interaction. I love the interaction that you guys have. So to kind of draw it all to a close, we've talked about a number of things, guys. We talked about the introduction. We talked about the benefits. We talked about some of the drawbacks. We talked about understanding what hard money lenders looking for, the difference between the two, how we've used hard money. Well, now to try to draw it to a close, guys, if you guys are out there and you're looking for hard money, don't be afraid of it. Just ask the question. Talk to the actual lenders. And guys, as we're drawing this to a close, what are some final tips you can give guys when they start thinking about using other people's money? I mean, it's kind of where the rubber meets the road, right? It's kind of like where you're getting serious. You find a deal, but sometimes wholesaling isn't really that serious. Let's just be honest. There's no risk, right? That you literally have nothing on the table. But when you're talking about taking money down, all of a sudden this whole stuff becomes real. What are some final takeaways to wrap this up as we're talking about dealing with hard money and circling around? Mark, you want to kick us off? Final thoughts.
Sure. Well, first of all, whoever this user is, if they want to continue the conversation a little bit further, I know you guys are in one of our groups. I think they're in Marty's group. Marty would be more than happy, or whoever's group it's in will be more than happy to kind of continue this conversation in the chat, even after this show, just going back and forth. And so we'll figure out where that's coming from because we can't see who it is. But I mean, I'd say the biggest thing is your mindset. Don't look at it. And Marty said this earlier. You have the deal. And if it's a sweet deal, the money's going to come. So it will definitely be there on it. So just kind of have that mindset and bring your friends into it and let them make some money along the way with you. That's kind of the main process. That's how I go about it.
I love it. Marty, final thoughts.
So yeah, I will be at the meeting Thursday. So yeah, let me know. Happy to talk with you about it. Final thoughts were, looking back when I first started, right? When I first started, having some sort of breakdown, kind of like Ronnie had, is something that I had, and I would send that out. If you have a really good deal, yes, the money will come, but you got to let people know, right? So you got to go to the meetups. You got to go to the networking. You got to go to do those things because now people know that you're a real asker for the money, right? Now, there's a problem sometimes with making sure the people giving the money are real, but there's a bigger problem with making sure the people that are asking are real, right? Because that person with the gold makes the decisions and makes the rules, and you kind of got to go and do those things. So yeah, I would have it in a spreadsheet of sort. So if you're like, well, how do I do, the asking for money? Well, put it into a spreadsheet, have some sort of breakdown, and that will automatically make you look 100 times, 99% better than a lot of the askers of money out there.
I love that. I think that's awesome. And guys, I would just say don't wait to start. If you're serious about getting into real estate, if you're serious about playing this game and making money, like don't just stay here. Like start having conversations, find the deal, put the money together. And one of my best lenders when we started, he sent me over a net worth sheet. And he's like, yo, just fill this out. And based on what it is, we'll have a conversation afterwards. I filled out the net worth sheet. I sent it back. Literally, the conversation was, oh, okay, cool. Yeah, it looks good. He's like, oh, by the way, you have a free and clear property? Like, we can put a line of credit on that if you want. And I was like, no, I'm good. Like, we don't need that. It's no problem. And literally, I closed the deal 3 weeks later. And it was like really, really simple. I literally reached out to him on a deal that I'm doing right now. I reached out to him. I said, hey, I have 2 deals I'm looking at. Interested. He's like, yeah. I was like, are you on the golf course? He's like, oh yeah, I'm out here. It's a nice day, blah, blah. Like, this is what these guys do. They're looking for operators. And if you are wanting to be a real operator, if you're wanting to put into work, if you're wanting to find a good deal, if you're willing to do the analysis, if you're willing to take it from purchase to sale, 3, 4, 5 months of diving into this process, and you're willing to ask questions of the lender, of other people to get this through, start having that conversation. But if you're hoping to just make it easy and like not do any work and not do anything and not solve any problems, and this probably isn't going to be for you, and people are going to be shying away. They're going to want to know either, do you have the experience, or do you have the hard work ethic that it's going to take to get you from A to Z? They have to make a decision on if they're going to work with you. And if you're that person, they want to talk to you. They want to talk to you, right? They want to meet the people who are looking for deals, who are finding deals, who are wanting to change the trajectory of their own personal net worth. Investors want to work with people like that. So guys, this has been an awesome episode. Follow us at Real Estate Power Play. Go to Apple and iTunes. Download, leave us a review there, guys. Go back. You can download all of our episodes, like it there, and then also go to our YouTube channel. Marty's got a YouTube channel. Mark's got one. I've got one. Go give us some love and subscribe to the channels. Until next time, guys. Peace.
This has been another episode of Real Estate Power Play, guiding real estate entrepreneurs to a brighter future. If you liked what you heard, consider subscribing wherever you listen to your podcast, or follow us on YouTube at Real Estate Power Play.